Hello, everyone. Happy New Year. Today on our first live show back on the Final Bar, we're featuring Ari Wald from Oppenheimer, one of the best in the business. We'll talk about sort of a overall view of what 2022 will look like. We'll talk about the way we begun this year. So far with today, a choppy day, the S&P flat for the day, the Dow positive, the NASDAQ weaker, growth really underperforming value so far with energy and financials in the driver's seat. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a very snowy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of StockCharts, using the best data visualization techniques, the technical toolkit to better understand market dynamics and focus on the message the markets provide back to us through indicators like price and breadth and sentiment. I mentioned the snowy Redmond, Washington. We've got about 6 or 7 inches on the ground, with a couple more coming overnight. Which in a place like Washington State, which is used to more rain, it's crippling the local functioning of the economy. But we will get through it for sure. Overall, the markets in sort of this choppy phase. It seems like, right, that big run higher at the end of December, pushing the S&P to new highs. We're now sort of stabilizing again. And I think all eyes will be on those breakout levels. Can we remain above the breakout level from December and stay there, right? A breakout is only meaningful if we can hold that breakout level. And I would argue, looking at a chart of the S&P 500, that is one of the main questions we want to be asking here as we get started. And we have great guests on this show to help us answer these questions. Ari Wald coming up here shortly should be a fantastic discussion. The rest of this week, on Wednesday the 5th, we have Jesse Felder from the Felder Report. On Thursday the 6th, Aaron Swenlin from Decision Point. We also have a bunch of really cool 2022 Market Outlook special events coming up. This Friday, Larry Williams is going to be giving a 2022 forecast. That'll be airing on StockCharts TV this Friday, and then we'll go on our on-demand platform as well. Next week, we have Martin Pring, discussion with Bruce Frazier that will air next week. Should be a great discussion from Martin, one of the best at cycles and sector rotation and asset allocation. Also, our StockCharts special event, Charting Forward 2022, comes up on January 18th. That's featuring people like Tony Dwyer from Canaccord Genuity, Jay Woods, who we interviewed on the floor of the New York Stock Exchange a couple years ago, giving us his take. John Markman, who's been a contributor to StockCharts.com. Should be a lot of fun. Great events coming up there. Also, as a reminder, our next Money Show event will be coming up pretty soon here. If you go to StockCharts.com/money show, I'll be doing a presentation next week. 7 questions to ask before every trade. That's their virtual expo. You can participate from your home or office or wherever you're at. We'll talk about how to use a technical toolkit and inject some discipline into your decision-making process. Go to StockCharts.com/money show to sign up for that event. Let us continue on today's show with our market recap. As I mentioned, sort of a choppy day yesterday, finishing in a position of strength. Today, more choppy, and we sort of had a rally in the afternoon and then coming off just going into the close. The S&P netted out to pretty much an unchanged day, just below 4,800 on the close. You have the Dow up about 0.6%, the NASDAQ down 1.3%. We're going to look a little later at growth versus value. That could be a key ratio to pay attention to. And a day like today is what makes me think of it, with tech, consumer down, energy, financials up fairly significantly, certainly favoring value here recently. Mid caps and small caps both in the green, though, with the small cap index up just over 0.6%, and the mega cap S&P 100 index down 0.3%. Other asset classes very quickly. So you've seen a nice push higher in interest rates so far as 2022 has begun. The 10-year yield is back into that range that it was. When we talk about the peak in rates sort of in the middle of 2021, we got up to around 170, 175. Then we went down to around 115, if I remember right, before coming back and then shopping around that 150, 160 range. We're back up into the upper end of that range where we spent much of 2021. And, the prospect of higher rates, the prospect of higher inflation, certainly a question I would encourage all investors to be thinking through. What would sustain higher inflation? What would higher rates do to your current positioning? At what point do you make changes if we continue to see rates go higher? The dollar index flat, but that stronger dollar environment that we saw through much of 2021, not really showing any signs of changing over the holidays, and stronger dollar has certainly been stronger U.S. versus non-U.S. Commodities, you see the DBC pushing higher, and the commodity complex sort of in the fourth quarter had that stabilizing period, that consolidation phase, arguably now potentially re-exerting it to the upside. So oil prices higher, the commodity index, whether you're using the DBC or like the CRB index or the Goldman index, all up today. The DBC up 1.2%, gold and silver up as well. Cryptocurrencies, a choppy experience over the holidays and continuing that today. Bitcoin for the last 2 days is really rotating around that 46.5 sort of range, currently around 46,250. Ethereum up while Bitcoin was down, currently just above 3,800. But both of those are pretty far off of their all-time highs and even off of their swing highs most recently. So it's been a choppy experience in the last week or two from cryptocurrencies, which is probably the most normal thing that I could tell you about. Now, when we look at the S&P 500 chart, we look at this chart at the beginning of most of our shows, and what is the overall trend here? Well, at year end and at the beginning of the year, when it's natural to think about where we've been and focus on where we're headed, taking a longer term view certainly makes sense. Here we're looking at essentially 2021 in one chart, just the beginnings of 2022, and it's hard to think of this as anything but a fairly consistent uptrend. Now, your experience as an investor in 2021 could have been vastly different than this chart. And that is the reality I think a lot of investors struggle with. Even if you got the market call right, you might not have had the right positioning because there's so much rotation, so many different leadership swings, and even you had false breakouts on things like small caps, that when the Russell 2000 broke to new highs and then really wasn't able to sustain that. But looking at the top level indexes overall, this is a chart in a fairly consistent uptrend. This shaded area that I'm highlighting around 4,700, when I think on the tactical time frame, I think that's the most important one to pay attention to. If you think about what happened in the fourth quarter of last year, September, we saw the peak around 45.50. We then pulled back in what ended up being the deepest drawdown of 2021, which was pretty low, only about 6%, 5 to 6%. From there, we exerted and went to new highs in the end of October, beginning of November. Then we've settled into this new range, 45.50, which had served as resistance, now serving as support, 4,700, which served as resistance, and now we've broken out. That's your level of support. So as always, if you would get any sort of pullback, I think it makes sense to look left. You start at the final bar, the current price bar, look to the left and see where we're at relative to those key levels. I think what is fairly reasonable about this chart is the fact that you have some clearly delineated support levels or potential support levels. 4,700, which is the November and December peak that was broken. 4,550, which was the September peak that was then broken. All of those have become confirmed by multiple retests as resistance, and now 4,550 tested as support. So I would be certainly paying attention to that level. Any other thing I would draw from this chart is the fact that the RSI, a good measure of momentum, has stalled out right around 60. And in a bullish phase, the RSI tends to be elevated and remain above 40. In a bearish phase, the RSI is unable to get above 60. And so that might be another important trend to watch there. I'll go quickly to our market trend model, which is our long-term trend following model, just because we didn't do a live show end of last week because of the New Year holiday. And just wanted to update on where we're at. That is, as you could probably guess, with the S&P not too far off of all-time highs. This is pretty much firing on all cylinders. Long-term, medium-term, short-term trends, all very positive. This is all based on weekly data using exponential moving averages, but it's essentially a systematic way that I created to essentially mirror what I was doing very subjectively, which was glancing at a long-term chart and just trying to generally assume or draw out the trends. What are the long-term, medium-term, short-term trends based on the price action? And at this point, they're all positive. And what this reminds me is regardless of what I think might happen, this chart tells you when things are actually happening. As long as the short-term model remains positive, the tactical trend is encouraging, and I shouldn't treat it as anything but that. As long as the medium-term model remains above zero, which it has since May of 2020, overall, the trend remains positive. Until that changes, I shouldn't be too worried about things. And that's what I would encourage you to think about on that chart in particular. We may have time for one more chart before the break, and I'll maybe make it this one. This is our chart of breadth conditions. This is a cumulative advanced decline line. So we have the S&P making new all-time highs in the last couple of weeks. What do the breadth measures tell us about it? And if there's if I'm looking for things to be less optimistic about, or things that cause me to be a little more cautionary, this might be one of the charts I would point you to. Now, the S&P advanced decline line has made new highs along with the S&P index. The mid cap advanced decline line has made new highs. The small cap AD line has not done so, still below the November highs. And the same can be said for the NYSE AD line using common stocks only. Now, both of these have bounced in the last couple of weeks over the holiday season, rotated higher, but I would want to see them eclipse their previous highs. So large cap breadth, thumbs up, mid cap breadth, thumbs up, small cap, and the NYSE breadth, not quite. That's why they're colored sort of that amber neutral color. I'd want to see them make new highs to confirm more of a broader bullish thesis. We need to take a quick commercial break. We'll be back with my guest, Ari Wald. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. It's so good to be back live with you. It was a nice break for family time, for holiday time, but boy, I miss doing these regular daily market updates with all of you, and excited to be back live with some really, really good guests in the coming weeks. Before we get to today's fantastic guest, Ari Wald, a couple quick announcements. First off, questions from you are super welcome. We're going to do a mailbag segment a little later in today's show. We got some great questions over the holidays. Keep them coming. We'll do another mailbag segment on Friday's show, and we'd love to feature your question on the air. Get your questions to us via email, thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our Stock Charts channel. We'll gather all of those. Hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. That's our on-demand platform. There's so much wonderful content. If you missed our year-end specials, they were fantastic. Top events, influential events from a technical perspective, some special events on how to wrap up your week and focus, or wrap up your year and focus on your performance, and so much more. Go to StockChartsTV.com. You can use your email address to set up a free account, or on your mobile device, just search for StockCharts TV on demand. I want to welcome on today's guest, Ari Wald. There's the technical analyst at Oppenheimer, based in the New York area. Always a pleasure to have Ari on the show, and I miss very much regular visits from Ari in my Fidelity days. Ari, welcome back to the show. Happy New Year.
Hey, Dave. Happy New Year to you. Always a pleasure to be on. Thanks for having me on. Really privileged to be the first guest of 2022.
It's good to see you. You have a high bar. Let's set the bar high for the rest of our guests if we could. We're talking, obviously, it's a natural time to think about what 2022 could look like. I think 2021 was a net positive year, but a frustrating year for a lot of investors, certainly. What are you seeing? Your first chart is looking, sort of setting the stage for this year. What do you have in mind here?
Yeah, we just published our 2022 outlook, so great time to be on. We call it our big numbers report. Lay out what we see as the anticipated roadmap for the equity cycle. First off, the key takeaway is for investors to be tactical. The bull should continue, but there's a case to be made that the best returns won't come until the back end of the year. So first chart highlights some of the assumptions that we're making. And I'm going to talk in terms of upside, I'm going to talk in terms of downside, and the ebbs and flows along the way. For upside, we show in our report that the average return at this stage of the bull cycle is pretty much just identical to the market's all-period average. So we're just using, for our 2022 target, a conservative 6% average return, and that's how we get to 5,100 at year end. Now, downside is going to depend on how high this December breakout can take the index. A 38% retracement would make a lot of sense to us along the way. This would line up nicely with the October low, and that's why we think 42.75 is likely to be the floor for the year. Finally, as we think about the ebbs and flows, we're following the US presidential cycle and believe a Q2 or Q3 low would set the stage for a meaningful opportunity ahead of what we call the sweet spot of the cycle, which starts in the fourth quarter.
It's an interesting take, and obviously a play on the seasonal trends, right? I mean, that sort of sell in May would play out really well with this sort of general trajectory for the markets. Your second chart area is focusing on what you alluded to, the presidential cycle. We're now in this on the third panel here. Talk through this chart for us.
Sure, it's the what we're showing is the S&P's average trajectory through the 4-year period during a first-term presidency. Now, it's really not a primary input to our analysis, but we think it's worthwhile to consider when the cycle is at an extreme, as it currently is. So what we're showing is that midterm years are weakest in the first half, which leads us to target a potential market top ahead of the upcoming sell in May period. We've also found that the fourth quarter of midterm years marks the start of the strongest 9-month stretch of the cycle that extends through the first half of pre-election years. This is why we believe a first half reset would be the secular bull market's next big opportunity.
So it's an interesting point. We only have a minute left, Ari, but if you're thinking about this overall trend and certainly strength over the holidays, potentially continuing now, what we've seen now in the first couple trading days of 2022 is a reemergence of sorts of some of the cyclical sectors. Charts like Facebook and Netflix and others kind of pulling back a little bit. Is there a case to be made for that cyclicals over growth sort of thesis, or where are you looking opportunistically now, given these assumptions about the future movements?
Yeah, I think the key action this week, which does pretend to additional upside that there could be legs to this, is the action in interest rates. To us, low and rising rates is a net positive for the equity market, good for cyclical sectors like financials. We'd be much more worried about almost the near mirror image if rates were ticking lower. So while it does argue for areas like financials, I do think technology, as much as it's been a bit hard hit in today's session, I think that still does well in this environment. We've shown time and time again that it's really had a zero correlation to the swings in interest rates as long as the 10-year is below 3%, which is well below that level. So I still think that hedge between financials and technology, they both rank high in our momentum work. We think they can work well together over the long term, not necessarily the same day, but even looking at the action over the last 52 weeks, both sectors have outperformed. So I think that makes the case that, again, a great combo together for portfolio construction.
I tried so hard to ask a short-term question, and you fought me in one area, giving a long-term answer, and very appropriately so. Listen, it's awesome to see you. Happy New Year. Thanks again for coming on, and we'll look forward to talking to you again soon.
I'll talk to you guys soon, Dave. Take care. Happy New Year.
That's Ari Wald. There's the technical analyst at Oppenheimer, based in New York, and I love that sort of general trajectory for stocks. And as he mentioned, I don't know if you caught it as sort of a little thing. He mentioned on the chart of the presidential cycle, it's not a primary input, but it's something to think about. And I think for cycle work, that's how I've often related to that. I would probably rarely make an investment decision based purely on a cycle coming due. However, I am fascinated when a cycle lines up with what I'm seeing on the analysis of price and trend and momentum. And I think there's a lot of wisdom in how Ari was answering that question. Great take there from Ari Wald from Oppenheimer. Let's continue on today's show answering your questions from the Final Bar mailbag. As a reminder, our email is the best way to get your questions to us, thefinalbar@stockcharts.com. And let's get to the first question. This is a longer question. I'm going to summarize it just to the sweet spot, the punchline, which was: is there any advantage to using daily new highs versus new lows to identify breadth participation as opposed to the daily bullish percent index or bullish percent indicator? And you went on and gave a great amount of detail about the bullish percent index, but how you're hearing a lot of CMTs on StockCharts and on social media. Very few reference the bullish percent index, very often referring to new highs and new lows. Really, really good question. And how would I answer that? I would say yes. I think, to be honest with you, the bullish percent index a little less widely followed than new highs and new lows. As you know, hopefully from watching the show, I tend to refer to both of those. The new highs and new lows are a very simplistic way of just looking at market participation. And oftentimes what you'd see is a divergence, right? Where, the index is moving higher, but you have not enough stocks making new 52-week highs. And the sustainability of a bull market phase is usually driven by individual stocks that are not just rallying, but are able to push and eclipse their previous highs. So new highs and new lows, if I would rank them in terms of popularity, probably more widely referred to than the second chart I'm showing, which is the bullish percent index. But to be honest with you, I think that relates to the fact that bar charts, which are what new highs and new lows are essentially based off of, right? Stocks just eclipsing a previous high or low. The bullish percent index is using point and figure charts. The point and figure methodology is probably used a little less often. I know I learned a lot about point and figure charting taking the CMT exams, getting to know Ken Tower and Jeremy Duplessis and others who have published some really good, Tom Dorsey and others who published some really good books on point and figure charting. But my conversations with them over the years have certainly convinced me of the value of point and figure charts. So I have if I have a New Year's resolution, is probably incorporate more point and figure charting into the show, so that we can understand that methodology better and see how it can add value. I talked with Bruce Fraser just before the holidays. We compared notes on that same thing. He is going to be interviewing, as I mentioned, Martin Pring for a special market outlook next week. So I'm wondering if you will sneak any point and figure charts into that discussion. Our next question, a year or so ago, there were a lot of narratives surrounding the idea of cash on the sidelines. Are you aware of a reliable data point, metric, or any real indicator of this concept? Had I really prepared for that question, I would have a really good chart readily available. I'm going to spend about 30 seconds thinking if I can do it. I think it's this one. This isn't bad. So basically, your question is, the idea of cash on the sidelines. I've had a lot of arguments with people about this over the years. Some will insist that that is a very valid way of thinking about it, and the idea is there's money that's taken out of the market and then it's reallocated into stocks. People like Greg Morris will tell you that is the most ridiculous idea ever created, and that is more of an anecdotal thing. There really isn't cash being taken out. But I know just from from my time on the institutional buy side, you really think about where you're going to be putting your money to work. The problem that with that whole cash on the sidelines concept is you're really not getting paid to have cash. And a lot of that idea of looking at, do you allocate, do you put your money in risk assets or do you take it out and put it in cash? You're really not just getting much by putting money in cash, right? And even putting money in fixed income instruments, not really getting a lot of yield on those. And so the benefits of moving your money out of equities has been pretty meaningless. To be honest with you, it's been fairly irrelevant. This chart, by the way, shows you the spread between the yield on the S&P 500 versus the yield on the 10-year Treasury. So basically, are you getting more for your money by investing it in stocks versus interest rate? This had been favoring stocks for for a little while in 2020. For most of 2021, it was negative, basically meaning once again the yield on stocks was so low that you're actually doing better off owning like a 10-year Treasury bond and just getting the payments from that. If you look, though, it's pretty much a wash between the two of those. And to be honest with you, if you look at a much longer term history, you'll see that 30 years ago, if you're a money manager with a large amount of capital to put to work, you actually gained quite a bit by taking it and having it in some cash-like instrument. So do I have a great way of measuring that? I don't really. And to be honest with you, there's a lot that's been done on like money supply indexes. Tom McClellan's done some pretty good work. And if you look at his articles on our top advisors corner on StockCharts.com, that's where I'd point you to see if there's any good data to use there. Next question. All members of StockCharts, including yourself, as noted during your show, have to deal with their long list of chart lists. Is there a possibility of saving chart lists in subfolders or subdirectories, which would help you focus on a few chart lists rather than 100 plus? Are there any plans for improving how you can organize and archive your chart lists? That is a really good question, and I guarantee I will make sure that Chip Anderson, our founder, and others hear your feedback, and I agree with you. So how can you manage your chart list? So I was taught early on by guys like Art Hill and Tom Boley and Grayson Rose. By the way, he did a special on his show recently, Stock Charts in Focus, where he focused on chart lists and how he managed them. He actually had some really good ideas. He uses a lot of symbols. So between exclamation marks and plus signs and then a bunch of numbers, you can do some really cool things with chart lists. If you just start putting them in alphabetical order, it's going to get really unwieldy really quick. And I have a bunch of sort of random scans at the end of my list, which are sort of a mishmash of things. And I pull those up and put them with numbers and symbols to reorder them how I want. I've gotten very comfortable with that methodology. Are there plans to improve that? Yeah, I think we're always looking to improve the platform. And I think looking at chart lists and ways to group them certainly is something that we're looking at. It's all about prioritizing that with a bunch of other really cool things that we want to do in 2022. I would encourage you to experiment with the symbols and the numerical ways to put them in a particular order. It is not hard to get your most important chart list at the top and even group them in a particular order. If you look at Grayson Rose, and then we did some specials, a chart school series last year on chart lists, I'd point you there for some good ideas. That's it. That's all the time we have for questions. I would encourage you to keep your questions coming. We didn't get to all of them today, but we'll make a point of doing so on Friday's show. So continue getting your questions our way. We need to wrap the show, though, and go to the 3 in 3, 3 charts in 3 minutes. Here we go. Chart number 1 is a very long-term view of the S&P 500. I'm talking S&P back to 1926. So we starting big picture. Again, year end is a natural time to take a step back. I recorded a couple special editions of this show the last couple of weeks of the year. I'd encourage you to go to our on-demand platform or our YouTube channel if you missed those, but they will help you think about some of the key charts that drove returns in 2021, and also some of the questions I'd encourage you to ask yourself, 10 questions to ask at year end. If you missed those, go back to them. But earlier today, I was recording the monthly chart review for my premium members at Market Misbehavior, and this is the first chart, or a version of this is the first chart we look at. It's a monthly view of the S&P 500 going back for decades. And the reason we always start the monthly review here is to focus on how the current movements fit into the long-term trend. There's been this sort of the 16 to 18 year bull bear cycle. I'm talking big picture bull and bear cycles, secular bull and bear trends. You have the secular bear market in the 1930s and 40s, the bull market phase in the 50s and 60s, what was called the go-go years on Wall Street. You then have the secular bear market of the 70s, the 1983 breakout where the Dow finally got above 1,000, then the bull phase in the 80s and 90s, the bear market phase in the 2000s into the teens, and then the bull market phase, I would argue, starting at 2013 was when I think you could confirm that was a bull market phase. And if you think of that 16 to 18 year bull bear cycle that we've seen, that tells you we're probably still not done with this overall bull market phase. Secular bull markets tend to last a little longer than we've seen so far. Even if you start the clock at 2019, we're still not done if you take the normal amount of time that bull market phases have gone. They tend to go on for quite some time. Now, having said that, even during the last secular bull market in the 80s and 90s, you had some career-busting drawdowns, right? The 87 crash, you had the Asian currency crisis, the Russian debt crisis. You had all sorts of things going on during this period. In 1994, which was an incredibly frustrating year, is just this little blip. So I don't mean to gloss over the fact that it can be a challenging trajectory, but the secular trend is most likely higher for a lot longer than January 2022. Chart number 2 is just to remind us, let's set some basic guideposts when we think about the tactical time frame. I would argue 4,700 is the first line in the sand. That's the first line of defense on any sort of pullback this week or in the coming weeks. The 50-day moving average not too far below there, currently around 46.66. Below there, 45.50. That was the resistance from September. We broke out in October, retested those that breakout level in November and December. That holding, I would argue, from a bigger sort of cyclical perspective, remains the S&P in a bullish phase. That's about 6% below current levels. Holding those levels of support on any drawdown would be incredibly important. Final chart, I will give full credit to David Lundgren, who's a former technical analyst and portfolio manager at Wellington Wellington Partners in Boston, who's a competitor of ours, but I got to know Dave and very much respect him and his work. He posted this chart earlier, and I wanted to give him some credit for that one. Looking at the relative performance of large cap growth versus value, I asked my guest Ari Wald today about the emergence of strength and value. And you're certainly seeing that with the last 4 weeks, seeing value outperform growth or growth underperform value. The small cap growth versus value index is actually making new lows for the last couple of years, but you're seeing trend line breaks on the growth versus value on large caps as well. Folks, that is our show. Again, it's so great to be back with you live here on the Final Bar. Special thank you to Ari Wald from Oppenheimer joining us from New York. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.